Warren, how would you define true success?
Well, I've said many times that if you get to be 65 or 70 and later, and the people that you want to have love you actually do love you, you're a success. I've never seen anybody.
Imagine you have $1,000 in your bank account. For most people, it is tempting to spend it on short-term pleasures, a new gadget, a weekend trip, or just padding your checking account. But what if you treated that $1,000 differently? What if, instead of spending it, you used it as the seed for a long-term investment portfolio that could grow into something life-changing over the next decade or more? In 2026, the tools, platforms, and opportunities make it possible for almost anyone to start investing with just $1,000. And the key is strategy, discipline, and understanding compounding. The first principle is mindset. A $1,000 portfolio may seem small today, but time is your ally. Most people focus on immediate results, waiting to get rich quick, or investing in speculative assets with high risk. The reality is that a long-term portfolio grows through consistency, compounding, and diversification, not gambling. Your $1,000 is the first step in a process that, if maintained properly, can expand exponentially over the years. Thinking long-term changes how you approach every investment decision. Step 1 is diversification. You do not want all $1,000 tied to a single stock, asset, or sector. Even with a small amount, you can spread your investments across multiple areas: equities, bonds, ETFs, real estate platforms, and even digital assets. Diversification reduces risk and allows different parts of your portfolio to grow at different rates, smoothing out market volatility. In 2206, micro-investing platforms and fractional shares make it possible to diversify with very little capital. What used to require tens of thousands is now accessible with just your initial $1,000. Step 2 is choosing low-cost, high-quality investments. Fees and hidden costs can eat into returns, especially when starting small. Exchange-traded funds, ETFs, index funds, and fractional stocks provide broad market exposure without high management fees. For example, a total stock market ETF gives you instant diversification across hundreds of companies, while keeping costs minimal. The goal is to maximize growth potential while minimizing unnecessary costs. Every dollar you save in fees is a dollar that compounds over time. Step 3 is allocating a portion to growth assets. In 2006, opportunities for growth go beyond traditional stocks. Fractional shares of high-quality tech companies, emerging market ETFs, or select cryptocurrency assets can add a growth component to your portfolio. Growth assets tend to be more volatile, but over time, they often outperform conservative options. The key is balance. A portion of your $1,000 goes into stable, income-producing investments, while another portion targets higher growth opportunities. Step 4 is including income-generating assets. Dividend-paying stocks, bonds, or real estate crowdfunding platforms can provide steady cash flow. Even small dividend payouts can be reinvested to buy more shares, accelerating growth through compounding. Over a decade, these income streams compound to significantly increase your portfolio's value, transforming modest contributions into meaningful wealth. Step 5 is automation. Set up automatic contributions, even small ones, to your investment accounts. The $1,000 is just the beginning. The habit of consistently adding to your portfolio is what creates long-term growth. Platforms in 2026 allow micro-investing with automatic recurring deposits, making the process seamless. Automation ensures discipline, which is far more powerful than occasional, sporadic investing. Step 6 is reinvesting returns. Dividends, interest, or capital gains should be reinvested rather than spent. Compounding works when returns are reinvested consistently. For example, if your dividend pays $20 in a year, reinvesting it buys more shares, which generate more dividends the next year. This snowball effect is the foundation of long-term wealth accumulation. Step 7 is using a core and satellite approach. Your $1,000 portfolio can have a core of stable, diversified investments, like an ETF that tracks the total stock market, or a bond index fund, and satellites of higher risk, higher reward investments, such as fractional shares of emerging companies or tokenized assets. The core provides stability, while the satellites provide growth potential. This strategy balances risk and reward, especially important when starting with a small portfolio. Step 8 is patience. The most common mistake new investors make is panic selling during short-term market declines. A $1,000 portfolio is particularly vulnerable to emotional reactions. Remember, markets fluctuate daily, but wealth is built over years. Staying invested, reinvesting returns, and maintaining a long-term view allows compounding to work its magic. Step 9 is leveraging modern tools. In 2026, AI-driven investment platforms, robo-advisors, and fractional investing apps allow you to optimize your portfolio automatically. These tools can analyze risk tolerance, rebalance your portfolio, and even suggest asset allocation based on market trends, all while requiring minimal effort. Using technology efficiently allows a small portfolio to grow without constant monitoring. Step 10 is continuing education. Even with $1,000, understanding how markets work, how compounding grows wealth, and how to manage risk is essential. Knowledge allows smarter allocation, better timing, and avoidance of common pitfalls. Over time, your investing acumen will grow alongside your portfolio, compounding your returns in 2 dimensions: capital and skill. Step 11 is strategic rebalancing. As your portfolio grows, the relative weight of assets changes. Some investments outperform, others underperform. Rebalancing ensures that your portfolio remains aligned with your goals and risk tolerance. In 2026, many apps allow automatic rebalancing, so even small portfolios maintain optimal diversification without manual intervention. Step 12 is taking advantage of tax-efficient accounts. Retirement accounts, tax-advantaged investment platforms, and long-term holding strategies minimize tax erosion on your returns. The more efficiently your $1,000 grows, the faster compounding works. Over decades, tax efficiency can significantly increase net gains. Step 13 is adding to your portfolio consistently. $1,000 is just the starting point. Even small regular contributions, $50 or $100 a month, can dramatically increase growth over a decade. The combination of consistent contributions, reinvested returns, and time in the market is the secret formula for turning a modest initial investment into a substantial portfolio. Step 14 is avoiding impulsive decisions. Fads, hot stock tips, or hype-driven assets can be tempting. Focus on quality, consistency, and diversification. In 2026, with an overwhelming amount of financial information available online, the challenge is choosing disciplined, evidence-based strategies over emotion-driven speculation. Step 15 is monitoring progress, not obsessing over daily fluctuations. The $1,000 portfolio will grow slowly at first. Checking daily or weekly can create anxiety and temptation to intervene unnecessarily. Track long-term trends, review quarterly or annually, and adjust only as needed. Patience compounds into results. Step 16 is leveraging small wins. Even $10 reinvested or an extra $50 monthly contribution accelerates growth over time. These small incremental increases snowball, especially with compounding interest and dividend reinvestment. Every dollar matters when building a long-term portfolio from a modest starting point. Step 17 is preparing for scaling. As your $1,000 grows to $5,000, $10,000 or more, additional strategies become available: diversified ETFs, international markets, small business investments, or alternative assets. Early experience with $1,000 builds the habits, knowledge, and systems necessary to manage larger sums effectively. Step 18 is maintaining flexibility. Your initial $1,000 allocation may need adjustments as goals, risk tolerance, and market conditions evolve. Maintaining a flexible strategy allows you to adapt without abandoning the principles of long-term growth. Finally, step 19 is committing to the journey. Many investors give up after initial fluctuations or minimal early returns. The power of a $1,000 portfolio lies in its potential to grow over time. Discipline, consistency, patience, and reinvestment transform a modest starting point into a substantial long-term investment portfolio capable of generating wealth, freedom, and opportunity. The beauty of starting with $1,000 in 2226 is that you do not need to wait for thousands more to enter the market. Micro-investing, fractional shares, AI-powered platforms, and global access allow anyone to start building wealth immediately. The process is clear. Diversify, invest in both growth and income assets, automate contributions and reinvestment, leverage modern tools, maintain patience, and continue learning. Over time, $1,000 evolves into a portfolio that grows exponentially, fueled by compounding, consistency, and strategic allocation. Your first $1,000 is not just money. It is the seed of financial independence. Start today, invest wisely, reinvest returns, and let time do its work. With strategy and discipline, what begins as a modest sum can turn into a diversified long-term investment portfolio capable of generating wealth for years to come.